Hello everyone, welcome to lecture number 38 of BHU SWAYAM course on Fundamentals of Economics and Financial Markets. Myself Dr. Anand Singh, and in this particular video I will be discussing with all of you regarding some of the important functions of stock exchanges. Now let us discuss about all those functions which I am going to discuss with all of you in this particular video. Now some of the functions are meaning and definition of stock market. First of all, we will discuss regarding what is the actual meaning of a stock exchange. Then we will discuss in detail about some of the major functions, such as point number 1, the function of capital formation. Point number 2, the function of transactions permitted in smaller lots. Then the function of continuous price formation of securities. Then the function of screen based trading. Then the function of liquidity of investments. Then the function of safety in dealings. And in the last segment of this particular video, we will discuss regarding one of the major function of stock market, that is concerned with the circuit breakers. So let us start this particular video. Now, let us understand what is the basic meaning of a stock market. Then we will discuss regarding the functions. The stock markets are basically a kind of recognized places which provides a platform for the trading of second-hand listed securities. Now, the stock exchanges, all the stock exchanges which are basically operating in our country, they are recognized places. They are recognized by the central government. All those companies or all those organizations who wish to carry on the activities of stock exchanges in our country, they are supposed to fulfill the provisions which are stated under the Securities Contract Regulations Act 1956. Now, after fulfilling those regulations which are prescribed under SCRA 1956, the central government may give or the central government may grant permission to such kind of companies to act as a stock exchange in our country. Since the central government is recognizing, that's why such kind of bodies or all the stock markets, they are basically known as the recognized bodies which provides a platform. Now, the stock exchanges, they basically deals with the second hand and listed securities. Now all the securities which are listed over the stock markets or which are traded over the stock market, they are basically second hand securities. Why? Because all such securities are already offered in the primary market. Now when the companies, they offer their securities in the primary market, at that point of time those securities are fresh securities or new securities. But when the company go for listing or when the company decides to trade its securities over the stock exchanges, then these shares which were earlier floated in the primary market, they are listed over the stock markets, and that's why those securities becomes old securities or second hand securities. Now, as such, listing is not compulsory, but for the purpose of trading, listing becomes compulsory. So it is said that stock markets basically deals with the listed securities. Now, let us discuss regarding the important functions of stock exchanges. Basically, these functions are enjoyed by or it is basically given by the Indian stock exchanges in our country. Some of the important functions are point number 1, capital formation. It is said that the stock exchanges helps in capital formation. It is one of the primary objective, it is one of the primary function of stock exchanges that they provides an opportunity to the companies. They provides a platform to the companies so that the company may float their securities over the trading platform of stock exchanges. Why? So that they can raise capital from the investors, so that they can raise money from the investors. Now, stock markets basically creates the habits of savings among the people, and these savings are basically channelized into investments. Under this function, the stock markets helps the companies to raise capital for their needs, such as the need of expansion. That means whenever a company wants to or wishes to expand its business, it needs additional capital. Now, from where the company is going to get capital or from where the company is going to get the resources, for that particular purpose, stock markets, they provides a platform. The companies can place their or the companies can offer their securities, the companies can list their securities over the stock markets so that the investors may make investments in such kind of securities, and for the purpose of expansion, for the purpose of expanding its operations, the companies might get sufficient funds. Now, the stock markets are basically utilized by the companies for investing in new projects also. Suppose a company has to make investments in the new projects, then it needs certain capital, it needs resources. From where it can collect the resources? Again, it can list its securities over the stock markets, where large number of investors can subscribe or they can purchase the securities of that particular company, and so large amount of money or resources can be availed, or it can be basically used by such kind of companies. Also, for the promotion of research and development, the companies need capital. Now, for every kind of capital, or whenever the company needs capital, there is an alternative that the company might list its securities over the stock markets, and it can get sufficient amount of funds in order to promote the research and development. So basically, stock markets provides a platform where capital formation can be done by the companies. Now, the second important function is trading is permitted in smaller lots also. Earlier, we have already discussed that during the past times, especially prior to 1947, trading was permitted in odd lots only, or trading was permitted in big lots only. That means whenever an investor has to purchase certain securities from any company, then trading was permitted in lots only, and the lot size used to be 100, 1000, etc. Now, nowadays, one of the major function or one of the major significant change which has been done in our Indian financial markets is trading is permitted in smaller lots also. Smaller lots basically means nowadays trading can be done in a single share also. For example, suppose if you want to purchase one share of Reliance Industries or any company, say Adani Enterprises, then you are permitted to purchase one security of either Reliance Industries or Adani Enterprises. It is permitted. That means trading in smaller quantity, even one share can be purchased. It is permitted by SEBI, also it is permitted by the stock exchanges. Earlier it was not permitted, but however, few broking firms allowed for trading in fractional shares also. That means instead of purchasing a single share, nowadays there are large number of firms, large number of broking firms who basically permits that investors can purchase a fraction of the shares also through a dividend reinvestment plan, that is DRIP, without commissions. That means permission is granted to the investors to make investments in a systematic manner or in a fractional shares, or they can purchase the fractional shares also. Now, nowadays there is no minimum order limit on the purchase of a publicly traded company stocks. That means the minimum amount or the minimum number of shares has been restricted to, or it has been declined to one share. Even few broking firms, they are permitting for purchase of fractions also. So there is no minimum limit. Earlier there was limit, but nowadays transactions have been permitted in smaller lots also. Now, the next important function we are going to discuss regarding the continuous price formation of securities. Nowadays, in our stock exchanges, the price formation of the securities happened on continuous basis. Now, the price formation is basically done by the stock exchanges continuously. Continuously here basically means during the trading hours. That means when trading is going on, then at the time of settlement of the securities, that means suppose a trading is going to be settled, then at that specific point of time, the prices are formed. It is said that the prices of the securities during the working hours or during the trading hours, it basically updated, or it's basically gets updated within a fraction of second, within 1 second or even less than a second. So continuous price formation of security is a process that occurs in a continuous market. That means when the market is going on, when the trading process is going on. Now, where securities are traded without interruption during market hours. Now, we know that the market hours, basically the genuine market hours, or that period during which the normal traders, they are permitted to regularly buy or sell their securities, that is started from 9:15 a.m. to 3:30 p.m. on every day. Every day here basically means except Saturday and Sunday, which is basically upon which the stock markets are closed. Also on gusted holidays, the stock markets are closed. That means basically on the working hour basically indicates when the stock market is open. During that particular day, from 9:15 a.m. to 3:30 p.m., regular trading may be done. As such, there is a pre-market hour also, and that starts from 9 a.m. to 9:15 a.m. Now, brokers place the orders. That means the individuals like me and you, we are not permitted to directly trade or directly quote or directly place the orders at this platform of the stock markets. Basically, we place our orders to the brokers, and the brokers on behalf of us, they place our orders at the stock market terminals. So the brokers place the orders and the share price changes every second. That means the continuous price formation is going on. The price formation happens every seconds or within few seconds due to the supply and demand of stocks in the market. That means what is the base on which the prices are basically formed? The base is what is the nature of supply and demand. If the demand is very high, then the prices are going to rise. That means they are going to increase. But if the demand is very less or no demand is there, then there is possibility that the prices may fall. Now, here what is important? One of the most important function of the stock market is that continuous price formation is going on, especially during the working hours. Now, let us move to the next function. The next function is screen-based trading. All of us knows that earlier, that means especially prior to 1992, prior to the establishment of SEBI, basically the physical form of securities were traded and the method of trading was open outcry system. But nowadays, screen-based trading is going on. Now, in the open outcry system, basically trading was done in an open area and the traders, they used to shout in a very loud manner and it seems that they are crying. That's why that particular methodology of trading in securities was basically known as open outcry system. But nowadays, open outcry system has been replaced by the screen-based trading. Now, open outcry system, why it was replaced? Because that system was highly ineffective and inefficient, plus it was very time consuming also. Nowadays, the open outcry system has been replaced by the screen-based trading. Now, before online trading, it could take around 60 days to buy or sell stocks and investors had to go through a lot of paperwork. That means the settlement of the securities. That means suppose you have purchased a security during the open outcry system era, then the settlement period was almost 60 days. That means suppose you are purchasing a stock today, then the name or your ownership or your name are going to be entered upon as or as shareholder in the name of that particular company within a period of or almost it takes 60 days. So it was time consuming. Also, large number of paperwork was basically involved in that particular process. So the government of India, with the help of NSE or NSE, the National Stock Exchange, which was established in 1992 and it started operating as a stock market in 1994. NSE introduced the screen-based trading system, that is known as SBTS, screen-based trading system or electronic trading system in 1994. That means in the same year when NSE started operating as a stock exchange, in the same year NSE basically introduced the screen-based trading system. Now, this particular system, that means screen-based trading system, allowed all the members to input the quantities of shares they wanted to trade and the prices they wanted to transact at. That means with the help of this particular system, what is the total number of security that an investor is willing to purchase, that particular number might be entered by the particular investor, and at what price the investor is willing to purchase the security. That means in screen based trading system, the investor was allowed to insert two things. Point number one, the exact number of shares which he wants to purchase or which he wants to sell, and point number two, what is the exact price at which the investor is willing to either sell or he is willing to purchase the securities. So due to the introduction of screen based trading system, the investors were free. They were completely free to enter both these values with the help of any electronic device or with the help of any computer device. Now, the transactions would be executed when a matching sale or buy order was from a counterparty. All of us knows that a trading or a trade is going to be executed, it is going to be finalized when there is a counterpart. Suppose you are willing to sell your shares at a specific price. Then if there is a corresponding buyer, then only the sale is going to be executed. In the same manner, suppose you are trying to purchase a share and somebody is going to sell that particular share at that specific price, then only the sale are going to be executed. So with the help of screen based trading system, when there is a matching sale or matching buy order, then such kind of transactions were executed. Now let us discuss regarding the next important function, that is basically concerned with internet based trading system. It is basically the continuation of screen based trading system. Earlier, that means first screen based trading system was introduced by NSE in the year 1994, when NSE started operating as a stock exchange. In the same year, it introduced the scheme of screen based trading system. Now in 2000, NSE opened its internet based trading system for its members. That means earlier it was not opened for its members, but from 2000 onwards, the internet based trading system was introduced, but initially it was applicable for the members only. Later on, or for the first time, Geojit Securities was the first company to go online. That means when NSE, it basically opened its internet based trading system for its members, thereafter the first company which go online, that was Geojit Securities. Later on in 2001, rolling settlements were introduced. Now this particular rolling settlement, it allowed investors to cover their positions the same day using an online trading app. Now thereafter, as of September 2023, India has around 129.7 million Demat accounts, and the popularity of online stock trading platform has increased due to the rise of internet and smartphone. That means prior to 1994, when the screen based trading system or when the online trading system, both of them were not operational, then large number of participants were not basically attracted towards the market. But with the introduction of screen based trading system and with the introduction of internet based trading right from 2000, then large number of investors, they were attracted towards the market. They started opening their own Demat account and were involved in the trading. So basically such kind of things or such kind of functions, they basically make a positive contribution in the development of our stock markets. Now let us discuss regarding next important function, that is basically concerned with liquidity of investments. Now let us discuss what is the meaning of liquidity. Then we will discuss regarding where the stocks, whether the stocks which are basically listed over the stock markets, whether they are liquid enough or not, and what is stated regarding the liquidity of investments in the stock markets. Now, liquidity in stocks measures how easily you can buy or sell stocks without affecting their price. That means, let us discuss this particular thing with the help of an example. Suppose I had one share of Reliance Industries and the market value, the current market prices of that particular share is say rupees 3000. Now, suppose I want to sell that particular security. Liquidity here basically indicates that specific price at which I am willing to sell those shares in the market. Now, if the share is very, very liquid, then there is maximum possibility then that it will be basically executed, or it will be basically purchased by a corresponding buyer in that particular market at that specific price. So, liquidity basically indicates how easily you can buy or how easily you can sell stocks without affecting their prices. That means at their prevailing prices, at the current market prices, if you are willing to dispose any share, then there must be a corresponding buyer or seller in order to either purchase or sell that particular stock. If the stocks are highly liquid, then there is a corresponding buyer. If the stocks are not liquid, then there is not a corresponding buyer or seller in the market. Now, liquidity also refers to the ease with which an asset can be converted into cash without significantly affecting its prices. Also, high liquidity indicates that an stock can be quickly sold or bought in the stock market at a price close to its true value or market value. Here basically term market value indicates that price at which the prices are currently traded in the market. Or what is the market value? That means what are the prevailing prices, at what price the securities are basically available for the purpose of purchase or sale in the market. So, high liquidity basically indicates that the stocks can be easily purchased or sold at the market price. Low liquidity basically indicates that the current stock or that particular stock is not, or it is not possible to purchase or sell that particular stock at that specific price. Now, stock market liquidity enables the easy buying and selling of securities without large price impacts. Now, let us discuss regarding next important function of the stock market. But before that particular function, let us discuss regarding the safety in dealings. That means what is stated regarding safety in dealings, that important function of stock exchange. Now, it is said that in stock markets, it is safe to deal in the securities, or it is quite safe to make investments in the shares or bonds or other securities which are basically listed over the stock markets. Now, let us discuss why it is said that investments which are made in the stock markets, or the dealings or the investments which we are basically going to made, or which we are making in the stock markets, they are quite safe. How the investments are safe, or why it is said safety in dealing is one of the major function of stock market. Now, all of us knows that SEBI was established in 1988 as an interim administrative body. Now, just after its establishment, basically SEBI was established in 1988, and later on, that means in 1992, SEBI Act 1992 was passed, and from then, that means from 1992, SEBI became the market regulatory body. So, safety in dealing is there because we have a regulatory body. There is a body who basically regulates the market. There is a body who basically supervises the market. There is a body who basically control all the activities which are going on in our market. Now, SEBI was also established with a twofold objective in mind. Now, what were the twofold objective? The first one was to frame rules and regulations. Since SEBI has to regulate the market, so it basically frames rules and regulations. Large number of regulations are basically framed by SEBI. For example, SEBI has framed SEBI Merchant Bankers Regulations 1992. So, in the same manner, large number of regulations have been framed in order to either control the intermediaries or in order to supervise the other activities which are going on in the market. But when SEBI frames the rules and regulations, it basically provides confidence to the market. It basically provides stability to the market. So, the dealings which we are made, or which we are basically making in our stock markets, those are quite safe. The second important objective behind the establishment of SEBI was to protect the interest of the investors. Now, as an investor, whenever we are making investments in the stock market, then there is a body, SEBI, which is going to or which is responsible in order to safeguard the interest of the investors. So it is also said that our dealings or our investments are quite safe in the stock markets. Now, SEBI has also framed SEBI DIP guidelines 2000. Now, DIP guidelines basically it is concerned with disclosure of investor protection guidelines. That means SEBI is doing large number of activities. It is passing guidelines, it is framing rules, it is framing regulations in order to protect the investors, all those investors who are basically making investments in the stock markets. Also, only stock brokers are permitted or they can only place orders on the stock exchanges. Now, why it is important? Because when investors have to make investments, they basically place their orders with the brokers. Now, who all the investors who are willing to make investments, the stock brokers they basically take KYC. That means know your customers. They after making proper investigations of those customers, they basically open their demat account. That means demat account of the investors are opened after making proper investigations of the investors. Also, there are large number of activities. For example, two-step verification can be done by the investors before placing the orders. So, all these activities are done by the brokers and the brokers are registered intermediaries. Also, the brokers place orders on behalf of the investors. Now, because the brokers are placing the orders at the stock market, that's why we are basically safe. We as investors are quite safe. So, because of large number of things, that means the role of broker, the role of other intermediaries, because of the role of SEBI as a market regulator, as a rule making body, as a regulations making body, and because SEBI has implemented the DIP guidelines also. So, because of all these factors, we can say that the investments which are made by the investors, they are quite safe in the market. Now, let us discuss regarding one of the most important function that is concerned with circuit breakers. Now, let us understand what is the meaning of circuit breaker and when it was implemented for the first time and what is the role of circuit breaker in the stock exchanges. Now, the concept of circuit breaker for the first time, it was triggered in the US securities market in October 1997. So, we can say that this particular concept was also adopted by Indian stock market from the US financial markets. Large number of functions, all those functions which are very good, they are good for the development of any stock market. Basically, we have taken from the US financial markets. Now, in the same manner, this particular function, that means the function of circuit breaker, was also adopted by the Indian stock markets from US financial markets. Now, SEBI introduced this circuit breakers in June 2001 to protect investors from significant losses and prevent market crashes. Now, let us discuss how it can prevent, that means how SEBI can prevent or how circuit breakers can prevent significant losses or how it can prevent the market crashes. Now, circuit breakers basically help maintain market calmness by giving traders time to react to price drops and re-access their positions. Now, a circuit breaker is basically a regulatory mechanism that temporarily stops trading on a stock exchange when the market becomes unstable. Circuit breakers are designed to prevent panic during buying or selling and to stabilize the market during periods of extreme volatility. Now, circuit breakers are triggered when a security or index breaches a predetermined percentage value. Now, let me explain this particular thing or the concept of circuit breaker with the help of an example. Suppose the prices of Reliance Industries, the price of one security of Reliance Industries is rupees 2000 and suppose the circuit breaker that is applicable upon Reliance Industries is 5%. Now, the circuit breaker basically implies that if the prices of a security goes beyond that particular limit. Now, in this case, the price was rupees 2000 per share and the circuit breaker was applicable upon 5%. That means, suppose if there is an increase in the prices of Reliance Industries by 5%, 5% of 2000 basically means 100 rupees. Now, suppose if the prices of that particular prices goes beyond 100 rupees, then the circuit breaker will be applicable upon that particular security. Now, suppose there is a decline in the prices of those security. Now, 2000 multiplied by 5%, that basically means 5%, that basically means 100 rupees. Now, suppose the prices of the Reliance Industries fall below the limit of 100, that means it goes around 1900 or less than 1900, then it is not possible to go below 1900. Why? Because at that specific limit, at 1900, the circuit breakers will be applicable and there will be a stop in the trading of that particular security. In the same manner, the prices of Reliance Industries at circuit breaker of 5%, it can't go beyond 2100 limits on a specific day. In the same manner, the circuit breakers are basically applicable in the form of 5%, 10%, 20% or 40% and so on. Now, circuit breakers are also applicable on a day basis, on a week basis. Now, on a day basis, circuits might be broken or opportunity might be given by SEBI. Now, why circuit breakers are applicable? Let us discuss regarding that particular thing. When triggered, that means when the circuits are triggered, that means when the stock prices are either increased or the stock prices are decreased beyond a limit, then circuit breakers stop trading for a set amount of time, which can range from 15 minutes to a full trading day. This allows market makers to share accurate information and for traders to access their positions. That means circuit breakers will be applicable, then trading for that particular security will be stopped. Now, as an investor, you will have proper time to access that particular situation. Circuit breakers are intended to protect investors and prevent stock market crashes. So, it was also a very important function which was introduced by SEBI. Now, in the next video, I will be discussing with all of you regarding some of the major other functions of stock exchanges. For example, the functions of speculative dealings are permitted in our stock exchanges. Then the stock exchanges, they guides in case of new issues. Now, the stock exchanges also acts as an intermediary or middleman. The stock exchanges, one of the major function is related to listing of securities. We will be discussing regarding the function of listing of securities in the next video. Then the function of dematerialization of securities. Then platform for public debts and globalized tradings are permitted in the securities. So, very thanks for watching this video.